On today's episode of the AI Investor Podcast from 24/7 Wall Street, we ask the question, has the market lost its mind? We dive into NVIDIA's earnings and guidance and share yet another new trade Eric is making in the portfolio. All of that is next. Welcome back, everyone. I am David Hanson, and I am joined by Eric Bleeker. Eric, we've got Thanksgiving next week. I'm so thankful for many things, my family, this show, the fact that I'm not short MicroStrategy. It's just a great season over here.
Not short anything right now, as we're about to talk about.
Exactly. Well, certainly, I'm not short MicroStrategy. I'm not, unfortunately, not long MicroStrategy. And we have a lot we want to talk about today. I want to start a little bit with just your sense of what's going on in the markets. It's been, again, 2 weeks since we talked. And every 2 week period feels like there's some craziness. And we had the election, we had the big run up, Indexes pulled back a little bit, but underneath that, there is a lot of return to speculative behavior, whether it is Bitcoin nearing $100,000 in price, a lot of smaller companies just seeing explosive moves in their stock price. And I wanted to hear kind of, how do you think about that as you're navigating such a big trend that we have seen explosive kind of business results? How do you kind of get comfortable with what's going on in the market? And I just wanted to hear your general thoughts on kind of the market madness, for lack of a better phrase.
Yeah, I mean, David, point blank, I'm pretty nervous right now because I think there's two differences that you can look at something like Bitcoin hitting 100,000. You can say, is that overvalued? Or you could look at S&P multiples. Like, where's the S&P 500 trading at historically? But then you can find things in the market that just feel purely irrational. As we've seen before, David, the craziest time I ever experienced investing was 2021. It was just an incredibly wild time with SPACs coming out constantly, stock shooting up at huge levels. And when you've been in a long winning streak, as it happened in 2021, because you had COVID, you had the excitement after, you had a lot of money coming out, people forget what it feels like to lose money. And that's kind of what creates cycles, because, there's psychological studies on this that it's some order of magnitude higher of how much it hurts to lose money than the joy you get from making money. So I think people lose a little sight from this. So I just want to run down. I've been keeping on my little market notepad, if you will, some of the excesses that I've seen that go from, okay, this is overvalued, to I feel like we're in a little period of madness right now. And David, I want you to rate each of these from 1 to 10. So you teed it off with MicroStrategy right now. MicroStrategy is, I believe, one of the top performing stocks in the market this year. Here's the madness, though. It holds very little business. It does have some business, but might be worth a few $1 billion in terms of their actual software offerings. The company is currently worth $90 billion, and its total Bitcoin holdings are a little more than 30 billion as we film. So it is trading at threefold the level of Bitcoin it holds. So David, in your market madness scale, where would you put that one on?
Is 10 is 10 being the most madness?
Yeah, 10's we are at the tippy top of 2021. Where are you putting down the scale?
I'm only going to put it at a 3, which might sound shocking to you, because I think you're going to have a few crazier things on the list. So I want to reserve some of my higher scores, but I'm going to put it as a 3. It obviously is shocking to see that. It's essentially turned into a levered hedge fund that just buys one asset, which is Bitcoin. So it's crazy, but I can at least understand that there is some strategy there. The strategy is basically to lever up or create more shares and buy more Bitcoin. So I'm going to mark it a 3. I'm not saying I'm going to go buy MicroStrategy, but I'm going to put that as a 3 on my scale.
Yeah, and a couple of fascinating things about Bitcoin. And again, I have no objections to Bitcoin. I own Bitcoin, but a couple key points here. Number one, Bitcoin ETFs, which MicroStrategy forms almost like a vehicle in lieu of ETFs. It was created before we really had Bitcoin ETFs. The amount of Bitcoin in assets under management from ETFs is within a couple percent of the amount held by Satoshi Nakamoto, the unknown creator of Bitcoin, and is within 20% of eclipsing the AUMs for all gold ETFs. So kind of interesting, kind of a sign of the times we're in. All right, David, here's number 2. SPACs are back. We are seeing companies like Archer Aviation up 87% in the past month. And David, you probably see this as well. If you go on to something like Twitter, you're starting to see the accounts posting their portfolios loaded to the gills with battery technology, quantum computing, speculative technology like electronic vertical takeoff vehicles, space stocks, speculative biotechnologies, and not just AI stocks, but the worst AI stocks. One that I've seen getting a lot more interest recently is C3.ai, one of my least favorite AI companies, because the reason it's named C3 is it was a climate change company. It rebranded to C3.ai to take advantage of the most recent trend. To me, it is, the kind of worst impetus of taking advantage of a trend rather than actually being a company at the forefront and delivering some innovation. So, David, where would you put SPACs returning on your scale of 1 to 10?
I'm going to bump it up a little bit to a 5. Again, I just want to caution listeners, watchers of when you see a huge influx of SPACs, it's usually because there's a huge demand for just investor appetite and risk taking. And SPACs are a very quick way to bring supply to the market. Again, just always think about things coming to the market as supply and demand. There's a lot of demand. There's an increased level of speculation. And that is just a very quick way to bring supply that may not be the most high quality supply to the market. So I can't believe we didn't learn our lesson in 2021 from the lessons learned from the SPAC boom there. So maybe it won't be quite as extreme, but I'm going to up that to a 5. I am not personally investing in any of these new SPACs coming to the market.
And there may be some companies within a group of former SPACs that, may be doing quite well for themselves. As a lot of them, it was a time for, as you mentioned, cashing in, and that we see these stocks rising at the top of the market every single day definitely says something about the current risk appetite. All right, I think I can get you above a 5 here. How about this headline? A kid, I believe he was 13 years old, created a cryptocurrency. He immediately rug pulled it, which was essentially pulling the proceeds out to crash the price. And to punish him, the cryptocurrency community bid this cryptocurrency up to $35 million in value. Where do you put the 13-year-old rug pulling on your scale of 1 to 10?
This is an 8. This is just
an 8.
Yes. If you're going to, I understand there's a whole community that maybe is going to revenge trade, but if you're out there and doing that, I mean, please don't put a lot of your money on this. I know it's a game, but that's an 8 for me. That's getting there.
All right. I think we can get up to 10 here. A banana sold at a art auction for $6.2 million for a crypto founder. This, you might have seen it, was a banana taped to the wall. It was estimated to go for $1.5 million because of past history. You don't actually get the banana because it would go bad. Instead, you get the duct tape instructions, how to tape a banana to a wall, and a certificate of authenticity. This was sold to the creator of the Tron cryptocurrency, who had previously bought a dinner with Warren Buffett. David, where'd you put this on your 1 to 10 scale?
This might be shocking to you. I'm going to bump it down to a 4.
A 4!
A 4. Because it's at least a unique thing that has been around for a while. It's not we just came. I remember reading about this banana years ago. Maybe not the same one again, since it's gone bad, but I'm not an art history major, but art is its own category. And I'm not surprised by things that might happen there that I don't understand. So I'm only going to give that one a 4.
Okay, we'll do one last crypto one, and then we'll do a couple stock ones. Goatsy Maximus. Do not Google Goatsy. That is our warning. It was a meme coin conceived by an AI chatbot. There's also some form of religion involved in this. It has become a meme coin, despite being named Goatsy, that has now reached more than $500 million in value. I think it slipped back a little before the filming. David, do we go over a 4? Or are we trending back down to this is just normal course of business here?
No, this is a 9. This one's a 9. If you lose money on Goatsy, you will not find sympathy at this podcast.
All right, we'll do another stock that we've talked about, which is Palantir. A member of its board posted to X, and I quote, "We are moving Palantir Tech to NASDAQ because it will force billions in ETF buying and deliver, quote, tendies, end quote, to our retail investors. Player haters, be aware that we've been hated for decades, plural. Everything we do is to reward and support our retail diamond hands following." David, nothing wrong with moving a stock to the NASDAQ, but saying you're doing it to essentially manipulate shorts and deliver tendies to your shareholders, I don't know. This is feeling pretty 2021 to me.
I don't know if you have the timestamp on that tweet. Was it around 3 p.m. on a Friday? Something like that?
It was definitely last week, and the stock was up 10% that day. The board member who did this deleted the post, deleted his account, and then Palantir subsequently dropped the following day. Although it is bad.
I know you've seen the movie Wolf of Wall Street when they go to lunch and order martinis until someone passes out. So I'm just going to go ahead and guess that maybe this board member had an aggressive lunch and came back and tweeted and then regretted that. So still a ludicrous thing to put out there. But so I'm going to give that one a 6.5.
Low chest pounding before that.
Exactly. Yeah.
Okay, final one, David. So Quantum Computing Inc., which was established in 2018 after a former homicide detective and current CEO bought a beverage company out of receivership to turn into a quantum computing software business. It has less than 400,000 in revenue. The revenue it had booked in prior years, they were only able to collect about 80. They were only able to collect about 14% of it. They built quantum computing software, and they jumped yesterday 30% and are now worth 580 million. Where'd you put this 1 to 10?
This will match my 9. This is a 9 again. We've seen stories like this. Please don't, in my opinion, don't invest in these companies. I remember a couple of years ago, there was a New Jersey deli that had something where it became a hugely valued market cap, and no mozzarella sandwich was that good. So I think it all came crashing down and went to zero. So
that was the poster child of 2021. That was Hometown Deli. It had about 25,000 sales from a single location in New Jersey. It reached a market cap of more than 100 million. It later merged with a bioplastics company. And spoiler alert, the chairman was charged with fraud, and that was kind of the end of that case. But David, again, just to wrap this up, I know that we want to have some fun with this. It just does seem like there are some really strong fundamentals. And one of the reasons that we've enjoyed artificial intelligence as a trend is, as we've talked about, a lot of the companies in this are making profits, often historic profits when you look at a company like NVIDIA. But there is kind of a background right now of exuberance. I think that it's going to be a little bit of a siren call to a lot of investors. You're going to see some of these stocks going up. And it's just a reminder that, well, AI is something that's very much in focus right now. We're probably going to see some relatively poor quality AI companies making some runs right now. Our focus here is truly to look for companies that we think have a high probability for success, I should say, are riding trends, have clear catalysts in the time ahead. A lot of the companies in 2021, people could have made a good case of, different electric, battery companies or this and that doing very well. But at the end of the day, valuation really outran any sort of reality facing any of these companies. So it feels like, it's kind of coming back a little bit right now. And it's just, I wanted to start this with a note of caution. This is also a reason too, that we will probably keep down our allocation to certain stocks like a Credo. There's a very high chance that could be a top performer in the portfolio over some amount of time. But I also think it's going to get put in, some categories of risk that we want to control. And we're just going to feel much better having larger allocations to companies like a Taiwan Semiconductor. It might not have exactly the upside, but it's going to build a strong portfolio, levered to the trend that's going to see strong growth, and it's going to allow people to sleep pretty well at night. So, I'm just going to put a bow tie on that. I think we've talked about kind of this crazy market environment. We had a little fun here today, but, really underscores how we're trying to approach the market given this background right now.
Yeah. And I don't think we want to poo-poo anyone who might be feeling that FOMO, or it is very hard to look at a company like MicroStrategy and be like, man, why didn't I buy this a year ago? I could have 5x'd my account. So those feelings are very real, but I think it's important to remember, there is some mean reversion in the markets when we talk about the rate at which you can compound over long periods of time. It tends not to be, 50% every month. So you just can't have those expectations. The greatest companies in the world will compound at 15% over a long period of time. So you got to remember and understand that why you're feeling maybe that you missed out, but don't chase is, I think, the core of what we want to get to. So you mentioned companies that make profits. So let's move on to NVIDIA, a company that makes just an obscene amount of profit. So we had their earnings. I think our first episode was right after their previous quarter. So we've been a whole quarter here. We've got another set of data from NVIDIA. What were your takeaways from this quarter? Anything new that you learned, or is it pretty much consensus going in?
Yeah, I mean, the headlines, I think revenue was 35.1 billion versus expectations of 33.1. That's fairly strong. EPS of 81 cents versus 74 cents. They're down, as we're filming this today, it's Friday. They're down 3%. They're down a little bit from where they were before earnings. I would say if there's one figure that's kind of driving negative sentiment, and albeit not a very huge direction, is their guidance for next quarter is 37.5 billion versus Wall Street at 37.1. The reality is it's expected they're going to beat Wall Street. And often what you want to look at is where kind of the institutional money, or as you'd call it, the buy side, is looking. And you never know quite where that is. You don't have, these services that aggregate numbers. But what I've heard is, they were looking for a number closer to 39 billion. So that's going to drive some of the near term kind of movements in the stocks. Now, what did I see in NVIDIA's earnings? Well, I think one of the key things that I saw, I think their business, it's truly impressive that they're able to keep demand flowing in their prior generation chips, knowing that everyone is waiting for this next generation. They actually said next quarter is when they'll probably hit the peak for their prior generation. They kind of reduced some fears and some uncertainty about their chips maybe facing overheating issues or not coming to market. They actually raised expectations for how many Blackwell, that next generation chips, they'll have next quarter. The one thing that I was a little concerned with that might be a little inside baseball, networking. So we've talked a lot. NVIDIA is trying to become a systems company. A lot of people think they're selling their GPUs. What NVIDIA wants to do is sell complete systems because they believe that gives a better experience to their customers. But from a competitive dynamics reason, it also makes them a lot stickier. It's going to increase kind of that moat, as you'd call it. Their networking revenue is forecast at 4.1 billion. It came in at 3.1 billion. That's a huge delta. It's a smaller part of their business, but it's not just about the money. It's also about what this might represent to their kind of long-term competitive advantage. So what I'm personally watching in there, David, this comes back to things that we've talked about on this podcast. One of the key reasons that we've wanted to add Broadcom into the portfolio is we thought that they would be able to be that alternative to NVIDIA, especially a lot of these hyperscalers, as they're trying to not become completely reliant on NVIDIA systems. They'll want Broadcom in their technology stack. So I'm curious whether or not this is just an order flow issue that might be resolved in a quarter or two later, or if they might actually be losing some share to Broadcom. Now, the last thing I'll do 2 points actually. Number one, this is a transitional quarter. Next quarter is what matters, because next quarter they're going to give forward guidance to that first, quarter of really ramp production for Blackwell chips. And that's going to give us some really good insight into kind of what the production amount is. They're still going to be supply constrained, but what NVIDIA is able to reach. So you really want to be looking ahead to next quarter. That's going to say a lot more about its business. The second thing, which will take us into the next kind of segment of the show we want to talk about, is a lot of the attention to NVIDIA was about something called scaling laws and whether or not AI is slowing down potentially. And I think that's going to become really a key focus around the company, because there is some question of whether or not some, you'd almost call them rules for the growth of AI that people thought were going to continue for years to come might be hitting a limit right now. And the implications across the entire AI chain are simply massive. So I think focusing in on the discussion what NVIDIA has to say around these scaling laws is probably the most important thing from these earnings.
And I think we're going to get into the scaling laws and just some of the challenges there, but just so people understand, what does that mean? Is that kind of the rate at which things are getting better? So I think that maybe the easy example, I know there's a lot of different AI models out there, but I think a lot of people maybe had experience with AI image creation 2 years ago when you'd say, give me a picture of a dog and a cat, and the dog would have its tail coming out of its head and not look that great. And then 2 years later, we have, you can't tell the difference mostly between is that kind of, that type of rate of improvement is what we were seeing. And is that what you're saying? There might be concerns of that slowing down of, hey, we've got this great picture, but it's harder to get it perfect from where we were?
Yeah. So I would say it was about a month ago. Mark Andreessen, who's famous venture capitalist. He's probably one of the most plugged in people in all of Silicon Valley. He dropped on his podcast that AI, what you'd call pre-training. I'll get into that a little bit more shortly. But he said it was hanging an asymptote, which, if you've done math before, an asymptote, you've got a big rate of increase and it's kind of stalling out. Then the information, which has kind of a checkered track record, but they had a large story about how AI was kind of reaching a limit on these same scaling laws. So let's talk just quickly about what scaling laws are. In 2017, there's a massive kind of breakthrough which predicates this current age of AI, which was the creation of transformers, which is just a different way of handling kind of artificial intelligence architecture. GPT, that just means generative pre-trained transformer. Transformer is in it. And what really caught people off guard was when OpenAI was going from their second generation GPT-2 to GPT-3, people thought that there was going to be diminishing returns on the structure of it, which was basically just feed a lot of data, feed more compute, and get better results in almost a linear relationship. Mm-hmm. And people thought this is going to slow down. You can't just do this generation to generation and not see kind of a decline in that linear relationship. You did not see a decline. And it created this almost, I don't want to say religion among people who follow AI, but something akin to it. A lot of people call it scale pilled, or whether or not you believe in this. And it kind of formed that basis of why people talk about, well, we'll do a $1 billion model this year, and then it's going to be 10 billion, and then it's going to be 100. It was because of this scaling law where the current structure for LLMs is more data, more compute, better results in this linear nature. Now, the scaling law, it's good to just about any company we talk about. Semiconductor companies, it's driving a lot of business. It's great for NVIDIA because, they're doing great under the status quo. It's great for data center companies because it starts creating this future where you have clusters for training of more than 1 million GPUs. The only companies that might kind of hurt, well, hyperscalers, right? They would like it to be cheaper, right? They would like to spend less. And like a ChatGPT, they want to be out in the technology lead, but they want to spend less. So what we've heard is we've been waiting for the next ChatGPT 5. We've been waiting for the next major Anthropic model, and there's been delays. And now what people are saying is because we are beginning to see declining, we aren't seeing the same rate of progress. We aren't seeing these scaling laws happening. And it presents kind of either two paths, an existential threat to AI, or we're going to create new scaling laws in new areas of AI, which we could talk about, David, that will allow us to continue moving at the same rate of progress, but just might be the innovation moves to new areas. So I don't know if there's anything you want to double click on from there, or, we could talk about what these paths look like as well.
Yeah, let's talk about, I think it's fair to say that AI is not going away. It's not, the box has been opened, it's here. And then it's a question of, like you said, the rate at which it improves and then how. So and maybe it's speculation at this point. I think it is speculation at this point of kind of what happens the next couple of years. We've made that clear when talking about NVIDIA that it's hard to forecast what does 2027, 2028 look like for this company, but maybe just put your speculative hat on a little bit. And what are some of those alternative paths? And does it change the way you think about the portfolio and the companies that you're looking at? Or is it pretty much just like, hey, it might be a different, process they're using, but all the same companies still benefit. It's still Credo. It's still Vertiv. What are you seeing if it does take a different path from where we've been?
Yeah. So the most likely path, I believe, and the one kind of championed by NVIDIA on its earnings call, which you always have to take with a grain of salt, right? You don't just listen and, right? Everyone's got an incentive. The founder of OpenAI, if he goes, oh, we're really slowing down, he doesn't get that next $10 billion check.
Yeah.
If Jensen Huang comes on the conference call for NVIDIA and says, things are looking kind of bleak, they're down 15% the next day, right? So you need to consider incentives. But essentially what's going on right now is pre-training, which, I had said earlier, it's basically just massive amounts of data fed into, ever larger, training clusters with more chips. They are seeing diminishing returns on that, but there's new ways of essentially creating models that I think OpenAI is really on the forefront. So there's two paths after this pre-training. One is post-training, and you get into things like reinforcement learning, fine tuning. You're really trying to work with what people would call more quality data. But what you can actually do in some of these newer models that OpenAI is working on is you essentially have agents, which we talked about on the show, and they do self-play where they're learning against themselves. And they're creating new training data by doing that. And then the final path that you have is something called real-time inferencing. And this actually might be the biggest transition. Basically, with real-time inferencing, it's reasoning where you inference and go step by step to a solution. And the model at every single step evaluates the best solution. And what I've seen from some of the OpenAI researchers is essentially that they believe that you can get, at its most wild amounts, you can get basically by following this process 100,000 times better input per unit of data, essentially. So, that might be, again, diminishing returns as you go bigger, and that's kind of at the outset. But the belief right now is that you're going to use a lot more of this real-time inferencing, and that's going to give better results, even as those pre-training scaling laws might change. Now, what are the practical considerations of that? Well, sometimes you need to be honest. We're very early, and everyone is trying to work this out right now, technology. Everyone is trying to work it out. We needed to do a segment where we talk about scaling laws, because I'll reference this, I'm sure, again in the future, because it becomes kind of the big change. But you could have paths where now you have maybe even more compute in the near term, because you still are buying all of your training equipment, but you're also adding inferencing onto that. We've talked about in the past that NVIDIA is stronger likely in training than inferencing. They're trying to make an argument that they're very strong in inferencing, but they're kind of having to fight up a low uphill. Well, who could that inferencing dollar go to? Well, a lot of these hyperscalers, the Microsofts, the Amazons of the world, they're trying to create their own custom chips. They're trying to do inferencing basically in-house. And the money there, as we've talked about, is going to companies like Marvell, which we add to the portfolio for this reason, and Broadcom, which we add to the portfolio for this reason. You could also see a company like AMD benefiting more. We have not added AMD, but if more money is moving to inferencing, that could happen. Also, will inferencing need as large of clusters? It depends on, really background things such as how large context windows might be for inferencing, but it creates brand new unknowns that could impact how we are going to play things like our optical plays in the future. And it could change even how data centers are constructed, which could go into how we're looking at power and some of these plays like Vertiv. Vertiv is very much a levered play to NVIDIA's Blackwell. So, David, I don't want to leave everyone out there with a throwing our hands up, but we need to establish what is happening today and how the key point is this change potentially is a breakthrough in AI in a new direction, but it does potentially change where the value is going. And we're working on that right now. I think it is going to change how we allocate some money in the portfolio. As of this moment, I'm a little bit less excited to put money in NVIDIA. We have money in NVIDIA, but I'm a little more excited about some of the alternative plays here. And then there is the other side, which I still haven't discussed, that it could be these reasoning models and, post-training and this real-time inferencing. It doesn't make up for the fact that we've lost the scaling laws and pre-training. And that could just be a net negative that could lead to, in that coming year, that scenario where we maybe have less investment from hyperscalers and we take a hit to the AI industry. While the trajectory is still up, it causes a little bit of that fumble we've talked about that you need to kind of gird yourself against. So the long and the short, once again, we're watching this, but there's a very good chance that this development will flow through to recommendations, buys, even sells that we're going to be making in the months ahead.
Well, I think we're watching it. I think it's also important to say the rest of Wall Street and the world is watching this. And a lot of these scenarios, have been somewhat priced into these stocks. Again, investing is always about understanding the probabilities of what might happen here. What if we go down this path? We talked again a lot about that NVIDIA story in the coming years, about maybe there's excess demand, maybe it's over. Like, there's a lot of different paths I can take, and all of those are being priced in. If it was clear that scaling laws were going to hold, I bet NVIDIA would be trading a lot higher than $142 a share if it was a certainty that that would happen. But the market is already discounting that to some extent. So I think the value we're trying to bring on this show is, do we have a different opinion? Do we have an edge, a little bit of understanding this is the scenario that's more likely to happen? And therefore, these are the companies that are going to benefit. So everyone, I think, is trying to get their probabilities of what might happen. And then we're trying to bring a differentiated take of, here's why we think this is slightly more likely to happen, or this is the outcome that we're going to be betting on. So I just wanted to kind of stress that a lot of these uncertainties, even though we talked about the enthusiasm in the market, they do feel somewhat priced in to some of these companies, of that the market is discounting that it's not always going to be great, and that NVIDIA is just destined to dominate for the next 10 years. Do you agree?
Yeah. And I one thing I have noticed, I haven't seen a category of AI shift so far that I'm like, oh, this is definitely a move incorporating some of this stuff happening in the background right now. But I do think some of our recent buy recommendations go a little non-consensus. And like our Marvell recommendation is, Marvell's up, but I think we have higher expectations than consensus about the value of kind of their Trainium chip contract with Amazon, right? So yes, every single time we are making a purchase recommendation, you are inherently going to be higher or lower than consensus to say, we want to move into this because we think there's going to, like you said, we think people are going to be moving into this or discounting some factor of in the future. So I think it's risk, but as you mentioned, it's also an opportunity to think a little bit differently about this market, right?
Yeah, and I think it's clear by the title of our podcast that we're long-term bullish on what this technology can do. But we've also said there can be times where there's going to be air gaps, and you might have a change in consensus, and some of these companies might trade 30% off, 40% off, even very large companies. Again, we just have to think back to a couple of years ago. Facebook, Meta made a huge bet on a technology that they're like, it didn't really work. And that stock was down 70%. Now, there was also broader market sentiment that was going on at the same time, but that can also happen too. So these companies can certainly trade down, but the amount of capital that's been deployed by some of these hyperscalers and NVIDIA, there's also just so much incentive to figure it out, right? If scaling laws, the traditional ones, don't work, there's a lot of incentive to let's try something else. So it's not going to be like, scaling laws didn't hold, let's pack up the AI bandwagon and go on home. So it feels like whether it's inference or some other path, there is so much capital at stake now that someone will figure something out. That would be my point.
Yeah, and I think too, just to echo what you said, if we are seeing maybe a little bit less progress than expected, they're not going. They have a lot of incentives to work through this. So for anyone thinking that you're about to see like an upcoming crash in the coming months in AI, it ain't happening, right? Because they have every reason to work through this. And again, it's still not entirely clear, right? Are we seeing some diminishing returns on the pre-training segment? It would seem we're hearing enough of that, but you have just a few labs doing kind of the cutting edge research on AI. There's very few people in the world who can put all this together and understand, is it we're seeing a diminishment of 70% or 30%, and do those other categories quickly make up for it? So I don't think I would be very cautious of anyone saying they have a complete picture here, because even to the smartest people in the world, this is very much in flux right now.
Well, we also don't want to put on our conspiracy hats too much, but when you talk about listen to what people say and incentives, there are many types of incentives. There might be incentive for someone to say that scaling laws aren't holding when they might be are. So there's a lot of game theory that might be going on here of one company saying something, and so yeah, I think the important thing is don't read one article and be like, that's it. So we've talked in prior episodes that we wanted to talk a little bit about the bear case. I don't know if this was the bear case, but I do think this sheds some light on some of the risks or some of the narratives that can take hold, because technology can be very narrative driven. And if that narrative flips, you can see a big change in multiples. So before we end, I did want to get to, let's shake off some of this bearishness or this bad juju we're throwing out. I wanted to get to a company that we are buying. And I wanted you to walk through, what is this company? What's the size of the allocation? Take it away.
Yeah, so we're going to add Ciena today. It's a $10 billion company. We'll do $10,000. It's very much in line with the trades we had made the prior week, just kind of getting more exposure to optical plays. Just companies very much levered to kind of the boom in data centers. So Ciena, it's a company that when I was covering technology for the Motley Fool, it was a very boring company. Their core market is core transport for telecoms. As I've talked about in the past, you had a huge overbuild of fiber. A lot of companies that are involved in this space, just very sleepy for a long time, kind of periods of excitement that they're going to have an opportunity followed by bust. It's a relatively cyclical industry. By Ciena's own admission, that kind of core market that they have for transport, it's only expected to grow like 2% annually. So there's nothing exciting there. Now, what is exciting about Ciena is this data center interconnection. I've said in the past on the show, I want to get some opportunities, not just for inside the data center itself, but the architecture of kind of connecting data centers together. You've got a company like Google. One of their most ambitious projects is creating a series of data centers around Omaha, Nebraska. They want to get all of these data centers coherent and connected together. They're also doing that in Ohio. If you've got two alternatives of a massive data center where you put everything, or you can kind of work out from a technology side to feel good about being able to get a collection in a geographic area, you'd much rather do that. And this is an opportunity that Ciena and also Marvell, which we had recommended last week, provides. Right now, their products that are able to connect data centers, and you might call it like a 60-mile range. They're absolutely booming. And David, I noticed this when I was kind of researching some of the recent earnings of the stocks we had recommended last week's. Every single one, you're always looking for that read through, and every single one, I'm looking down their product categories, and then they get to kind of these pluggables. You call it, I think it's a ZR400 for Ciena. They're saying this is where we're seeing the most demand. This is where we're seeing the most demand. And kind of the read through on that is the company that's really going to see a lot of the growth coming up ahead is Ciena. So their core market is expected to grow at 2% CAGR. These markets, these data center interconnection markets I'm excited about, they're projecting at more of a 36% CAGR through, I think I've got the note right here, 2027. And on top of that, the investment cycle for telecom is coming off a bottom. So it's not exciting, but you're getting that tailwind. Add it all up, I think this kind of completes a little bit of that optical play that we've created. It continues to give people more of kind of the exciting opportunities into the data center boom. And at $10,000, once again, it just provides more diversification where, if you're buying Coherent and Fabrinet and Lumentum and Ciena, they all have kind of different advantages. They have different products, but you're able to get exposure across a category that, again, it's just going to have, I think, a tailwind at its back, even with some of the changes that we talked about today. I think these companies, if I see something that we change our minds, we can always, change our allocations, but I continue to think these companies have a strong tailwind at their back. So I really like Ciena. It's a $10,000 allocation, and we'll add that to the portfolio. And I think in the weeks ahead, David, we'll continue to look around. I think I'd like to target some of the kind of software plays and the companies on the software side next that we think will kind of benefit from AI, now that we've recommended a really strong stable of kind of data center and semiconductor companies as well. There we
go. That was Ciena. Ticker symbol is CIEN. If you didn't mention that, and if you pull up its stock chart, it almost looks like MicroStrategy going back to the .com. It had quite a run, and yes, it has survived. It's had lots of acquisitions and permutations, and it is still here today. So again, fitting with like you said, a common theme of the portfolio of legacy business, not super exciting, but does have kind of the exposure to a new growing trend. So that'll be one to watch. And like you said, we'll keep looking for companies. I think maybe in the next 1 or 2 episodes, maybe we'll do a bigger portfolio review just for any new listeners who have come on. We can go through all of I think we have 10, 13 companies in that range now in the portfolio. So lots of movement. Eric, anything else before we sign off?
No, I think, it's a time where, it's exciting, right? There is some uncertainty, but this is when digging in and really understanding something can truly have the most value. So I'm excited just to continue learning more about this. And, if you've been following AI and you kind of wish that you were there for the creation of a chat GPT or something, you wish you had been there early, maybe this is an opportunity for a really big tectonic shift and to kind of be there from the ground floor. So I'm excited. I hope everyone listening today, there is some uncertainty. I hope they're excited because I think it's going to be fun to really follow this up in the months to come.
All right. Sounds great. Have a good Thanksgiving next week, everyone. Eric, I am mailing you a banana with some tape for your decoration. So be on the lookout.
Send me the $6.2 million bill. It will be coming.
I will. See everyone later. People on this show may have interest in the stocks they talk about. This is not investment advice, so don't buy or sell based solely on what you hear.